Morning, everybody. Welcome to Ainsley News. It's Thursday. It's the 3rd of February. Today we're talking the Fed and how it will tear apart our economy. Today we explore a bit deeper into the view held by many respected analysts in the US Fed and certainly by extension our own RBA. And we'll be tightening policy into an economy or business cycle coming off its peak, what we think is the very worst time to be doing so. One of the smartest minds we respect is macro insiders Julian Brigden. For some time, Brigden has been talking about the very macro phenomenon he calls the Great Moderation. In essence, starting with the collapse of the Berlin Wall, then China's entry into the WTO and resulting globalization, the world went through a quarter of a century of a halcyon period of unbridled capitalism, disinflation, and critically lower economic volatility. That, of course, has changed. Had started to change, evidenced by Trump and Brexit, but now with COVID was a big catalysing agent. Driven by inequality, social unrest, and underpinned by shifting demographics, voters in the West were beginning to demand change. Furthermore, even our political and corporate masters were beginning to question the logic of handing the keys to the Kingdom of China. Hence our contention that these slow-moving dynamics, such as ageing demographics, which support higher bond yields, would have ended the Great Moderation on their own. In that sense, COVID was simply a powerful accelerant. Brigden talks to research done around the causes of economic shocks and inflation. In short, history is littered with exogenous forces entering a market at exactly the wrong time and become pro-cyclical as to exacerbate or amplify sorts of cycles depicted that we've talked about. He provides the metaphor for the famous Tacoma Bridge, where simplistically the frequency of the effects of the wind matched the natural frequency of the bridge and harmonic or mechanical resonance occurs. If you've never seen the footage of the outcome, you need to watch it, particularly the current economic metaphor firmly in mind. If you haven't checked out Tacoma Bridge, just do a quick Google search and check it out. I saw it when I was a lot younger. There's some beautiful black and white footage there. It looks ridiculous, but it really did happen. Brigden provides the very familiar historical example of the second half of the 60s, when concurrent policy errors coalesced to end the longest period of stable inflation in the post-war period. The first error was Johnson's Great Society spending in 1965, which hit an economy already operating close to capacity as the Vietnam War ramped up. The second was a Fed that initially thought they could run a high-pressure economy with higher wages in order to draw workers back into the market. Sounds a bit familiar, doesn't it? Especially if you've been checking out the jobs market in Australia at the moment. But as inflation accelerated, they changed their mind abruptly and tightened policy. Unfortunately, their tardy response hit an economy that was already peaking. A subsequent equity and housing drop just added to the volatility. That's the resonance. What followed was more of the same, with policy increasing reactive and buffeted between successively higher inflation and increasingly dynamic market gyrations. Far from dampening cycles, poorly timed reactive policy added to cyclical amplitudes. The results were plain to see, and are. In December 2021, ex-Fed President Koshalata raised the risks of rising inflation and the need for immediate aggressive Fed response, warning, you guessed it, the Fed faces a troubling 1965 parallel. But of course the Fed procrastinated and simply talked about tapering. Not rate rises, not QT, just less of more new money. That means the response will need to be both more aggressive and ill-timed. Ex-NY Fed President Dudley recently warned, how high will rates need to go? This depends on how easily higher rates will tighten financial conditions and cool off the economy. So far, there's little sign they'll have more effect. All this suggests the Fed will have to raise short-term rates considerably more than what's currently anticipated. The charts that we show you today clearly illustrate how completely distorted the current setup is, with the blue line US shares as a proxy for the economy and a green line showing how loose or tight Fed policy is. Never looser and never more overheated. Jump over to ainsleyBullion.com.au and click on news. You'll be able to review all of these charts today just to see how things look. Now let's remind ourselves of the relationship between US shares and money printing via QE. Print money equals shares go up, stop equals shares go down. Tighten equals major corrections. Brigden then cites a recent research paper that $100 billion of new money would increase the stock market value by $300 to $800 billion, and that the value changes are permanent so long as the flow is not removed. If the balance sheet declined, aka QT, the multiplier effect to the downside would be just as great. Take a second to digest what that actually means. The real kicker is that the hyper-financialization of the real economy means that any correction in stocks will quickly manifest itself both in soft indicators such as confidence and concrete metrics like employment and capex. All these charts we're showing you today on our website are critically important. There is now a clear correlation between the share market and unemployment, as well as manufacturing and capex. We have just seen the worst start to a year for US shares since 2009, and that was the GFC. May we remind you that it was on this announcement that we'll likely soon raise rates by a measly 1%, and it's likely, and maybe reduce the Fed balance sheet via quantitative tightening. Maybe. Pretty soft news, but have a look at the effects. Brigden's sparring partner, Raoul Pal, is firmly in the view that we're about to see a dramatic slowing of the economy, coinciding with all this news. Again, more resonance. So here we are with markets rebounding over the last 2 nights on hopes none of the above or what we've talked about today is real, and that we only see a 1% in total and spread out with the latest Fed commentary hinting at a calibrated approach to raise interest rates to fight high inflation, i.e. the market may be realizing that more than 1% was priced in. History shows they will reverse if the market tanks anyway, and hence buying the dip. And so again, we're in for a volatile ride ahead as this cognitive dissonance dance continues. Don't get sucked into these everything is awesome rallies, and refer to the metaphorical bridge. Tomorrow we share part 2 of this excellent piece of work from Brigden, where we bring in that elephant into the inflation room, inventory, and how it historically fits in with these economic and business cycles. And that's news today. Thanks for joining us, everyone. Over to ainsleyBullion.com.au for all things physical, gold, silver and platinum, ainsleywealth.com.au for all things cryptocurrency. Click on that dashboard icon today, guys, and gals, and you'll be able to see a little interesting bit of stuff here from Into the Block. We've just integrated some lovely insight into each coin/token. Go and check that out. And goldsilverstandard.com. That's around crypto built and backed by real gold and silver. We'll catch you tomorrow.